Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world. This is our new series, LPack, where we bring on previous guests on the podcast to answer your questions on how to build your venture fund. If you're a fund manager and need advice, you can submit your questions to me at cupofjoe.com/contact. That's cupofzhou.com/contact. And maybe we'll have you on the podcast next. So today, we have the Avengers, the amazing team at Screendoor, a venture capital fund-to-funds platform redefining how LPs access and invest in early-stage VC emerging managers. With over a decade of experience in pensions, family offices, and financial institutions, Cawley, Layne Johnson, and Jamie Rhode specialize in identifying and backing the next wave of venture capital leaders, offering early visibility and access to VC firms shaping the future of innovation. They provide LPs access to highly competitive VC managers, driving alpha that would be challenging for LPs to otherwise identify, access, and underwrite. Screendoor uniquely integrates their robust LP frameworks with the strategic expertise of accomplished GPs from firms like Homebrew, Forerunner, Precursor, and First Round, enabling them to source and underwrite the non-obvious in emerging manager selection and support process. Screendoor is a strategic partner to many prominent institutions, including endowments, foundations, RIAs, and family offices, because they not only offer potential returns-driven portfolio exposure, but also a valuable pipeline of direct relationships for LPs' own portfolios as these funds mature. So you can find Jamie on Season 1, Episode 4, and Lisa on Season 3, Episode 5, as well as how Lisa thinks about succession planning and generational transitions at venture firms in our post-season episode on Season 3, when VC funds become firms, and Layne on an upcoming episode in the near future. So if you didn't have a pen and paper or an AI note taker to listen in for you here, don't worry, we'll link all the aforementioned down in the episode description. So without further ado, the first time the entire team at Screendoor is on a podcast. I should play that back. Why didn't we play that Eagles kind of banter back and forth? Do we have any other sports fans among the other two of you?
I'm a suffering Orioles fan. I get it. Every year we think it's going to be our year, and then some variable.
I'm an Astros fan, but Jamie and Lisa really hate that about me, and they don't like me to share it publicly. So I try to keep it to myself.
Wait, Layne's husband is a Cowboys fan, so him and I have a lot of fun banter.
Okay. Lots to go between. How often do your families get together with each other, out of curiosity?
At least a couple times a year.
Oh,
they're part of it. We joke they're our interns.
Yes. Yes, they are.
It was actually funny because I was at an AGM yesterday and it was a solo GP. All three of you definitely know who she is. She brought her husband and her kids in, and I think they said the exact same thing on stage as well. The kids were like 2 and 5 years old. And I don't know. It was fun to see the human aspect of it. And I feel like for some reason prior to the pandemic, we all lost that because we all pretended to be someone we weren't.
Honestly, my favorite thing about the pandemic was it opened up, not that there should have been favorite things about the pandemic, just to be clear, but It opened up people where you could have you'd be on a board meeting or an LPack meeting or a GP call, and someone's kid or their dog would come through, and it would open up an entirely new avenue of conversation that almost would get everybody's guard down and actually have a more enjoyable, productive conversation, still resulting in you're doing a business transaction, but you get to know the person so much better, which, as we were saying before, it's you either care about the next 24 hours or you're just thinking about year 10. So super helpful to learn that about people in the background.
I 100% agree. I am a lot of our job is to understand people almost outside of a professional context as well. And that's why we like to meet them at cafes and restaurants and meet them live. And that pandemic version of dogs running in, cats going crazy, kids running in, was just that element of, yes, we're on a screen, but I'm getting layers of dimension in your character as well.
Totally. I'd say the ethos of Screendoor is understanding a manager's lived experiences and how that informs their strategy and decision making. And so having the opportunity to really see the personal side and, get the opportunity to walk a mile in their shoes is really helped from an investment standpoint.
I also feel like it's after the pandemic and everyone moved to Zoom, it almost is you had to re-find this muscle of meeting in person, because it is so important to see someone face to face. And I think like a different level of what's going on in your life outside of work comes up when you're like sitting down for a coffee as opposed to just getting on a 30-minute Zoom. And so it's like, you can't just get comfortable in the Zoom routine. You got to keep seeing each other in person and making that happen.
I 100% agree. And there's always curiosities I have. It's like, okay, are there things, hypothetically, most people that I meet for the first time are on Zoom. Are there things we can talk about or do on Zoom that would help me see other elements of their background? But anyways, speaking of Zoom, not that like Zoom, I say colloquially, this is like Google Meet, Microsoft Teams, you name it kind of thing. We're on Riverside. Riverside is not a sponsor, but I like to shout out as many times as I can because I love Riverside. But speaking of meeting people on Riverside, I'd love to bring in our first caller, Linus. So I'm going to let him out of the room here. Linus, what's up?
Doing well. How's everybody doing?
Good.
This morning.
Great.
Nice. Well, great to meet everybody.
This is morning for us, but everyone else here, they're like around, or they're coming up on noon. So they're a little further in their day. We're time traveling here.
We are. I love it. Well, great to meet everyone. Thanks for the time.
Thanks for joining us.
Absolutely.
Thanks. Yeah, thanks for joining us. These are relatively quick fire-esque of sorts, but now that we have you on, I will call out and say that you have one of my favorite firm titles, like firm names ever. And so I nerd out about this because that was part of my childhood and all that, but I won't spoil too much. I won't bury the lead here. Linus, could you tell us a little bit more about you and the firm and all that kind of stuff?
Sure. Yeah, absolutely. So myself, very quick summary, born in the Bay Area, both parents were in tech, so naturally learned and gravitated toward technology, studied computer science at Berkeley, and then went to Stanford, originally going into academia, becoming a CS professor, but decided to drop out. I ended up being a founder and for 15 years, starting several different companies before jumping into venture. So always loved technology. This is the best job in the world now. I get to meet people creating the next generation of entrepreneurs and inventing new tech, and it's amazing. So I started Kyber in 2022. It spun out of a previous firm called Signia, which was an early stage VC fund. And then before that, I was at Andreessen for a little bit. But the firm itself, alluding to what David was talking about, we call it Kyber Night. It's a little bit of an inside joke, a call out to Kyber crystals, which power Jedi lightsabers. And we, instead of calling it Jedi Capital or something, getting sued by Disney, we try to make it a little bit under the radar. But the idea is because when we started the fund, when we spun out of Signia, the idea was to really help entrepreneurs at the early stages, particularly with trying to navigate the product market fit route, trying to find customers, helping them with customer traction. And that was the most important thing. When I was a founder, going from seed to Series A was the hardest thing. It wasn't the marketing. It wasn't recruiting. If you're a good founder, you never need that, right? And what we wanted to do was leverage our LP network to help founders get those customer contracts, right? Because nobody wants to work with a 2-person startup. And the only way you can really get into these big companies is if you have either inside track on who to sell to, how to sell to them, and that's what our LP network provides. So that's the high level of the firm. And and then I do have a question. I think that's the next on the agenda, correct?
That's the next one. I was gonna. Perfect. You read my mind.
Yeah, that was the first time I did this. But my question and I talked to David a lot about this, and my question to a lot of the people deploying capital is we are an emerging fund. I'm a third-time fund manager, but with Kyber, this is my first fund. And when I talk to a lot of LPs, and especially when they're backing emerging managers, I'm always wondered on the incentive structure, because when you back an emerging manager, it means waiting for years, maybe even decades, to see how that fund performs. And on the LP side, how that bet pays off. And given that you might not see any upside for a very long time, why take that risk so far down the road? And why take that chance on an emerging manager rather than investing in maybe in a proven or established fund where, you don't really put your job on the line? And I've always wondered what it takes to take that risk. And I think that is something a lot of new emerging managers are also very curious about.
Yeah, I can jump in here. I think while there is maybe less of a track record and it seems higher risk to be investing in emerging managers, there is so much data out there that does say they outperform. And there's so many reasons for that. One being often emerging managers are raising smaller funds and more early stage focused. And so not only from a portfolio math perspective, you have a much better chance of making higher returns at the fund level, just because it's a lot easier to outperform on a $50 million fund than a $400 million fund or $2 billion fund. And also, if you're at the early stages, like you're just getting in at that very first round, you're getting in at a very low entry valuation, and there's so much more upside. And then there's also a lot of more qualitative reasons emerging managers outperform. Probably the first and foremost is it's like you're betting your career on this next step. Like you have a huge chip on your shoulder. You're trying to prove something. So obviously that's very subjective, but then there's all the economic alignment. And so you're not getting super rich off the management fees. Again, with a $30 million fund,
right.
$50 million fund, like you only prove success if you outperform on a performance level. So from an LP perspective, the alignment of incentives is so much there. Totally understand what you're saying on if you back a great brand, established firm, it's probably less like career risk for you. You have good company. There's a lot of other great LPs in those firms, but every time those firms raise another fund, it's different than the last one, and it's different than the one before that. And so technically you're underwriting a track record, but you're probably underwriting a track record when the fund size was a little bit smaller, the strategy was a little different,
Sure.
The team has probably changed a bit. So you're not underwriting an emerging manager, of course, but you are technically underwriting like maybe an emerging strategy and team in the same way you would be doing at a fund one.
Thank you.
Layne, to follow up on that, are there kinds of LPs who are predispositioned to like emerging managers? Because I've actually heard this saying fairly recently, which is like, you either believe in Jesus or you don't, right? And you either believe that emerging managers will outperform or you don't. And convincing someone who doesn't already believe that is just like an uphill battle. But the question back to you, like going full circle, are there kinds of LPs that say an emerging manager should be targeting that would be more open to their strategy?
I think there are a bunch of LPs out there from a structural reason. It's really challenging to access emerging managers on their own, whether it's because their team is super small or like it's one person that's covering all of private markets, let alone private equity, let alone venture. Like it's really hard to canvas the universe. There's so many emerging managers out there. Check size is another big structural constraint for a lot of LPs. So if you have to write a $20 million check to be able just to make it like move the needle in your own portfolio, then you can't really get into a bunch of $25 million, $50 million funds without being a really large part of the LP base.
Yeah. Linus, a question for you.
Do you have anything to add?
Oh yeah, go for it. Like Jamie, Lisa, anything?
No, I think Layne did a great job covering it. I think I would just mention that I've been investing in emerging managers for over a decade now, and my original intention was never to target emerging managers. My intention was actually to target funds that wrote the first institutional check into a startup because I was looking for a way to compound capital at an extremely high rate. And that just led me to backing emerging managers because finding a fund that was willing to invest at the pre-seed and seed consistently over the very long term either meant by the time they had a track record that it was underwritable with DPI, I couldn't get in. Or they were, an established manager that was slowly creeping up into bigger and bigger fund size. So they were going closer to Series A and Series B. And so what I ended up realizing is to go access that part of the market, I had to do emerging managers. And then I found my own version of managers that stayed sub 75 million forever, and I got lucky that I found the right ones, back them, and could be an LP there for a very long period of time. Because to get exposure to this part of the market, once they're underwritable in terms of established, you probably can't get access.
Yeah, and I think for me, like I've been really fortunate to like apprentice and learn and invest within portfolios where there was a role for both emerging and established, both for financial return standpoint, but also for strategic reasons. And I think really fondly of like all of that time and how the market has changed. But I think one of the key takeaways I've always had, whether it was a decade ago, whether it was 5 years ago now, or even as I think kind of what is on the horizon here, like a lot of allocators, and I think just participants in investing in general like to ask, like, how do I know that this firm and this team is good? Like, how do I know? So how do I do that? I'm going to sit and I'm going to wait for that robust track record before I make a decision, because that de-risks what I'm doing here, right? And so by way of thinking about that, like a lot of what we do in underwriting is backwards looking, but really in VC, you want to be forward looking. So it's really important to take those in as data points. But if you are making a majority of your decision based on those backward-looking data points, I would argue that you're probably missing the mark when it comes to emerging managers. Like, you actually want to be asking, how do I know that this firm or this team is still going to have an edge in inevitably what would be a new market environment? There's going to be new competitive forces. There's going to be new technologies, new innovation, like new at every level, which suggests that their prior performance, classic saying, past performance not indicative of future results. Like, I think that that's probably immediately true in emerging managers. So, I mean, I'm a firm believer that if you are waiting to see the proof smack you in the face, like you're actually not participating in the proof. So you're not actually getting that performance. You're not getting those returns. You're sitting and you're waiting. And by the way, everybody else in the market is doing the same thing. So then you're competing against them. And then, just because somebody, can identify, right, that that's a great brand at that point, it doesn't mean that just because you have capital, you can get access. So it's one of those balances where you have to think about the role of VC in a portfolio. And like Jamie talks about this really, really eloquently when it comes to asset allocation. Like, you should be taking risk. So if you're trying to de-risk by waiting so long, to Linus's point, like you're not actually participating in it. Like, you're just doing something fundamentally different. You're not participating in the risk.
Also, if you were to invest in an established manager that truly did early stage, your timeline of DPI is likely the same as an emerging manager. So the time to see if this fund produced me venture-like returns is the same as any other fund manager. Yes, there could be less career risk associated with it, but anecdotally and through combing through various data sets, we've just seen, as Layne iterated, the upside potential that emerging managers really can offer to an asset allocation.
That's great.
Well, and that's maybe like one last question here for you. What are some, like, when you were in market and when you were talking to LPs and all that, what were some of the hesitations or pushbacks you got from LPs that I assume would have led you to this question?
Well, I'll directly answer your question first, and I had a follow-up. So I think the main hesitation is, it's every reason, right? And I think they're all valid, right? From anywhere from, we want to track a little bit more, first fund, you're just spitting out, and we want to see how the team works, to a lot of the times it's just we don't have the allocation right now because we're overweighted in one or another. And like I said, there's a lot of different reasons why. I think where I was going with the question, though, to the second part is, I understand why people invest in emerging managers and why it's important to have that as an asset class, part of the portfolio in the overall venture asset class. But I think I was trying to really figure out, and I find this very opaque. It's like, how are people that are deploying capital, how are they incentivized in terms of their bonus? Like at the end of the year, for example, and I don't know how it works, but do you guys get a bonus on what you've invested in or how some emerging managers performed? And I'm trying to figure out what moves the dial just incentively, or what incentivizes monetarily from the personal perspective, if that makes sense.
Every LP gets paid differently. And I would say when you are meeting with prospective LPs as a GP, make sure you do your due diligence because you're signing up for a marriage and you want to make sure the alignment is there.
Exactly.
So I think that is fair at a proper point in the due diligence process, maybe not meeting one, but asking, around why are you investing in venture? What is the long-term expectation that you have for the venture capital asset class? Because we've all come across LPs that do get paid on IRR or get paid on DPI. The return potentials that can be offered in early stage venture are unlike any other asset class that we've come across. But unfortunately, people's comp needs to be structured appropriately for the illiquidity and duration benefits that venture offers.
I appreciate it. Unfortunately, sorry, I only budgeted till 8:45. I have to run. I promised to take the kids to school today. I'd love to hear more. I guess I'll have to listen to this offline at some point when this is all produced. But thank you so much, David, for joining everyone together, putting this all together. It's really interesting. Great to meet everybody. And I look forward to hearing more. Thank you.
Thanks for calling in.
All right. See you, everyone. Bye.
I love how Linus mentions needing to pick up the kids, and we were literally just talking about life outside of like the Zoom camera.
Yes.
I was just hoping they were going to come into frame. That would have been totally icing on the cake.
No, they're like, Dad, you promised to send it to school. Like, what happened? What are you doing? Who are you talking to? Going back to the last point you mentioned, Jamie, about some people get compensated on IRR, some people get compensated on DPI, some people get compensated on just assets they manage, like assets under management.
Yeah.
What is a benign way that a GP can ask an LP of like, where are your incentives without being too upfront and being too facetious?
Yeah, I think a great way to start that conversation is asking about their experience in venture to date, and then also asking about their expectations, because there's some LPs out there that do fund investing purely for co-investment and direct deal flow, which is able to maybe fund that DPI payment a little bit better, because if you invest in a high quality emerging manager that gives you access to Series A deal flow, you could jump in and that could pop and return. I mean, Wiz has not been a confirmed acquisition, but 5 years, 100 million to 32 billion, 300x, like that's awesome. Also, why you need consistent vintage year exposure, because you really don't know when the winners are coming. But, each LP has a different intention as to why they're investing in venture or why they're looking to invest in this potential manager. So it is a fair question to ask around why venture. How do you think about the asset class? How do you think about return expectations? It's also important to talk to the LP base, because family offices, because they're taxable LPs, may not want you to sell out early. They may want you to hold and compound capital, where non-taxable LPs may want the capital back faster because of their payout needs and whatnot. So it's important to ask the questions around why venture and your return expectations, and that sometimes allows you to eloquently ask the question around comp.
I think it's also understanding their history with venture. So not just necessarily what are you looking for at this moment, but what have you done in the past? And maybe they'll be willing to share examples of other VC funds they've invested in with you. And maybe not, but at least they'll give you a profile of other VC funds they've invested with. And if it's not an emerging manager or it's not an early stage manager, you can ask okay, so why the change? Why are you talking to me? Is it a change in your program? Are y'all looking to do this now? And that can also just instead of just asking how are you paid and how will my performance help your compensation, you might get a better sense of just the program.
Yeah, would not leave with, so tell me about your paycheck. Tell me about that composition. Start with portfolio, not paycheck.
I want to let our next caller in, Kate from NOMO. Hello.
Hi, everyone.
Hi, Kate.
Hi.
Hi, Kate.
Nice to meet you all.
I haven't seen you in a while.
I know, it's so good to see your face.
I know. We used to, I think we still try to hang out weekly, bi-weekly, give or take. Anyways, we can go on and on about it. Kate, could you tell us a little bit more about NOMO, how you got here, and what you guys are doing?
Overlooked repeat founders who are building what we like to call revenge businesses. We started investing in 2013, and our inaugural fund has already distributed 7.5x. And our earned insight, which is what we've learned over the past decade of investing, is that we like to back repeat founders who've actually fallen short of a big outcome before, so like those with sub $25 million outcomes, because they're actually most likely to outperform. They have less execution risk at the pre-seed stage because they've already learned how to do everything a founder needs to learn how to do. We can also diligence exactly which type of execution risk is highest with each founder, and then we can figure out how to de-risk it. And they also are very hungry to prove themselves. They've already practiced resilience building as a founder before, and so they have higher levels of resiliency going into the next company. And what we found is that this combination is most likely to actually build an outlier software company. We looked into the data, and it turns out this pattern holds true at a larger scale across thousands of companies. The founder that's most likely to build an outlier software company is not a first-time founder, and surprisingly not a repeat founder who's already proven successful with a big outcome. It's actually a repeat founder who just needs to prove themselves, and they're actually out for revenge.
I love the terminology revenge, but I also like to take a step back. Kate, how did you find yourself in the investing role? Because if I remember correctly, you were an operator. You spent tons of time there, and you did very well there as well.
Yes, my partner and I actually both met on the founder side. We're both former founders ourselves. Between the two of us, we've started and sold to venture-backed companies, and we decided to become investors because we actually had suboptimal experiences with our own investors, and we wanted to kind of fill the void that we felt was at least in our experience, that we felt the pain of. And so that's why we decided to become investors, and we've been building NOMO for a decade now, which is crazy to say. But yes.
And I actually had this conversation with both of you fairly recently. Where does the name NOMO come from? Because it might not be the most obvious place where people find the origin of the name.
Yes. No, it's definitely not. It actually stands for nostalgic modern. So a lot of our LPs are actually folks who have built generational businesses before, and they're kind of investing in the next generation of founders building these great businesses. So that's the modern piece. So that's the origin of the NOMO story.
I love it. And so I think you brought a question for the amazing team here at Screendoor, and yes. I'll let you take it away there.
Yeah, yes. So venture capital is inherently opaque, right? There are long investment time horizons. There's the unpredictable nature of startup success. There's reliance on informal relationships and networks. And so LPs don't always have, clear visibility into GP decision-making processes or sourcing strategies, portfolio construction assumptions, and I think, or even, real-time portfolio company performance. And so I'm wondering, in your view, which aspect of the venture ecosystem is most opaque or difficult to understand, and how would greater transparency and a deeper understanding influence your investment strategy?
I love this question because this is like a huge why as to when Lisa called me and was like, will you come to Screendoor? And I was like, yes, because backing managers, and I spoke about this before you joined. So I've been investing in emerging managers for over a decade, and my goal was to target fund managers that were the first institutional check into a startup. It was not to back emerging managers, but to be able to do that meant I had to go into emerging managers because a lot of the established names or a lot of the early stage funds I couldn't get access to, or they just weren't doing pre-seed and seed. And actually sometimes Series A is the first check in. But there was so much friction and complexity to actually make the investment, on top of having to do a massive market map around who are the emerging managers and how do I understand which ones are accessing the top 1% of founders? And if I want coverage of this area of the market, I need to understand the population first. And so after sifting through at that point, like thousands, I was finally comfortable to make investment decisions. But then came the headaches of back office or lack of back office, the operational complexities around it, the legal complexities around it, where being an institutional fund manager, half your job is investing. So for me, it was understanding what drives a manager quality and what drives the manager's long-term success. Well, that's understanding repeatable edge, access to top 1% founders. Do they have firm building instincts? Because you don't know at that point if you're a fund one or fund two. I have no idea if you have the chops to go from investor to fund manager. But to your point, most LPs don't have that data. They don't have that access. They don't have the context to see excellence over the years and know what it takes to truly succeed in this business, because only 20% of early stage venture funds produce a 3x net or greater. And if you're investing in early stage venture, you're in it for 3x or greater. But the other half of the job is being a fund manager. So the operational complexities and the legal challenges and the friction of the back and forth, because that's just a headache and most investors don't want to deal with it. And that's where Screendoor came into play and was started by established GPs because they recognized there needed to be an LP in the market that could be that safe LP and truly help you go from investor to fund manager. The GPs we back, they're founder magnets. They're sifting through networks where they can access top 1% founders, but we're here to help those GPs go from investor to fund manager because it's really hard and it's a headache. And Lisa can jump in, but the amount of time she spends on the legal negotiations or the operational due diligence, it's not worth it to a lot of LPs, especially if they're writing or looking to write $20 million checks. It's a lot easier to go to someone that has been doing this for more time, is at a $300 million fund size, and has a more institutional framework in place already.
Yeah, I'd say the other thing that is quite opaque when you're underwriting an emerging manager, and we talked about this a little bit earlier, but there is less of an established track record. There's less just like numbers to look at, basically. And so in terms of like actually understanding a manager's picking ability and their ability to like have good judgment on founders and products and potential markets, you have to really dig into the companies because there might not be markups yet, or there might be very early markups, but you have to understand how the company is actually progressing in terms of, revenue and customer count, but also have they been able to hire exceptional early teams, and how is their product roadmap going, and have they hit all the KPIs the VC had laid out at the beginning? And that just takes more work. You can't just look at a markup in a track record sheet. You have to actually dig into the companies and learn more. So I think that's the other harder, more opaque part of investing in emerging managers.
Yeah, and I think not every LP is equipped to be able to do that, right? There's some where kind of their limitations, whether due to bandwidth or coverage that each individual person on the investment team is tasked with, they're maybe only able to kind of do those check boxes or look for that quantitative data set to really validate where opportunities lie that are appropriate for their portfolio. And that's what makes it tough, because if you're only checking boxes, if you're only looking at top line numbers, you're probably going to miss a majority of what's to come and call it the next phase and next generation of ventures. So I couldn't agree more. And I think, if you maybe take a zoom out of what's also hard for LPs, that's really the bigger kind of population issue, is that, when you think about the contrast between a decade ago versus, the venture landscape now, whether emerging, established, however you want to slice it, there's just factually thousands of venture firms now. And we can bucket them all we want into emerging and established. Yes, there's a majority of those I'd say are in that emerging category. And many of them are really, really, really promising and exciting. But when LPs are only seeing a small subset of the population and not framing it against the rest of the market, again, whether emerging or established, that's what I actually think creates a lot of friction, and also creates maybe some, preconceived notions about what venture is or does in their portfolio. So if you see 40 managers a year, that's probably not an adequate population to make, 1 to 5 individual fund commitments off of. But that may be all that someone is either capable of, all that they have coming their way, just by way of what their own coverage is. So I think, it's really, really important for LPs that are interested in having this as part of their asset allocation to be like constantly questioning and really, really, really refining their sourcing, and whether that's having a team fully focused on it. And I would argue like it can't just be one person. It really, truly is so much more multidimensional in today's market and the go forward market, or whether that's leveraging fund of funds or things like that, where you can actually know that you have coverage of the population and be selecting into the managers and the funds that are most appropriate for your portfolio. And that answer is going to be different from LP to LP. That answer is going to be different from even within LP categories. What's right for, one family office over here is going to be, completely different for the next family office. Same goes for endowments, same goes for institutions. And so I think a lot of it comes down to the landscape is opaque, and what everybody knows is the top line number. And then maybe like the 20 firms or 40 firms that come their way in a year, and they kind of are missing that gap.
100%. I think it's so important to have this conversation because transparency doesn't only help LPs. I mean, it does help LPs, and obviously LPs would be better equipped to make intelligent capital allocation decisions. But for GPs, it does help to build deeper trust with their LPs. And that trickles all the way down to founders who benefit from funding sources that have these stronger, fully aligned LP-GP dynamics. And so I think the entire venture capital value chain can actually benefit from greater transparency and deeper understanding between LPs and GPs. So I appreciate all of your answers. Thank you.
Yeah, I think you actually hit on one of the things that's like core to just how we philosophically think at Screendoor, and that it's really good for founders to have choices. And so if you follow that up the food chain, that's why emerging managers are so special and play such an important role in the ecosystem, because they give founders choices and who they can take capital from that are best suited for their personalities, for their styles, for their business, for where they are in their journey. So I am very pro lots of little firms being able to, maybe one day be big firms, or maybe one day be kind of steady state at the same number.
Yes, definitely. Thank you. I know, David, we're running up against time. I don't want to go over. Is there anything else that we missed?
I think that's it. I mean, Kate, hopefully that answers your question, but thanks also for sharing that context. I have nothing more to add than to everything that the Screendoor team has already shared. So thank you for jumping on. Appreciate you as always, and we'll talk soon.
Thank you all so much. Great to meet you.
Thanks, Kate.
Thanks.
Thanks, Kate. And thanks, David, too, for setting this up.
You're welcome. So question for all three of you. I'm curious, like we talked about metrics earlier, and there are kinds of metrics that LPs who aren't, let's say, fully literate in venture typically look at: TVPI, DPI, IRR kind of thing. For you guys, or for just LPs that are more venture literate, are there other kinds of metrics or examples of other kinds of metrics that one might be looking into that takes looking into hundreds, thousands of firms to understand?
I think it depends more on what your goals are as a venture investor. And so I think that everyone knows IRR, they know MOIC, they know TVPI, they know DPI. I think when you're thinking about putting venture in the asset allocation, unfortunately, a lot of those metrics are not comparable to other asset classes. So if you want to build an asset allocation and say, I have public markets, I have buyout, I have real estate, I have private credit and venture, how do I compare all of them? It's apples to oranges. And so there's ways to go about it, and certain data sets that allow you to slice the data a certain way by looking at time-weighted returns, or you could turn your returns into CAGRs, which is what we have done before, where you find out that the last 20% of time produces half of your return in venture if you're accessing top quartile returns. So the patience piece is really, really important if you're doing early stage. But I think there's a way to think about it as an LP building an asset allocation and turning each asset class return in a way to compare each other, so you properly know how to size return expectations. And then there's another piece of it where you're looking at the individual portfolio companies and kind of digging in. And I think there's nuances amongst sectors. Like if you're investing in a therapeutics company, you're not seeing revenue until maybe after exit. So you have to be able to calibrate and keep yourself flexible enough to understand that there's nuances amongst the different sectors in venture.
I think another area of like data that you can look at and that we look at a lot is even if track record is still early, you can see the check sizes they were able to write, the ownership they were able to get, and the average median entry valuation they've gone in at, and just line it up with what they said they were going to do. And so like, have they been able to achieve 5% ownership in this fund one and get into a bunch of pre-seed companies below 15 million valuation, or has that crept up? And there could be a very good reason why it's crept up, but it's data that can prompt really good conversation around like how they've actually been able to interact and play in the VC ecosystem they might be executing right on strategy, or they might have had to evolve over time. And there's a great reason why.
I think too, this is maybe where I wouldn't say I disagree, but I have kind of a more expanded definition of how I think about the world, where like the data matters, the top line metrics matter, the company metrics matter. Setting all of that aside though, like this is where like venture is almost like art versus science, where to me, the two metrics, right, which cannot be put on a paper, which can't always be, numerically quantified, are talent and then feedback ability. And so when I think about, especially emerging managers, I always look at how have they been able to attract talent? Like what is the caliber of what they've added to the team and the thoughtfulness that goes behind that? And I think sometimes you can tell a lot, like does 1 + 1 = 10? And you can just look at that and you can sense that with how the team operates when you see them together, whether in person or Zoom, like there's lots of ways to go about kind of observing that. I think we've talked before, maybe in prior episodes too, about like, just sitting down with somebody and like, having lunch with them and like getting to know how they interact with everybody around them that has nothing to do with you and nothing to do with the business context. Like that's the talent, that's the people piece. And I think, the feedback piece is really what I always love about venture. And I probably say this all the time is like, it is like a commitment to lifelong learning. And I think once you think you know everything, you're already behind. And you should always go into probably every week, if not every day, especially in this world, like expecting that you're going to be learning something new and something you thought before is going to be challenged or debunked. And so when we come across folks, I always like to understand how they're going to be a feedback filter as opposed to someone who's going to take 110% of what we say versus like 0% of what we say. Like, I don't love either of those extremes. I like people, and, Jamie says this frequently too, and Layne, like strong opinions loosely held. So like, what are kind of your core frameworks and principles that you'll, explore around the edges, but like really hold true to? And then when new information is introduced, that you actually show that you can take it in and truly like evolve that going forward. So talent and feedback, like can't put it in a box. Maybe you could argue you can put it on some sort of like framework or, scale of rating people. But at the end of the day, like that's the art of observing, how some of that comes to play.
On that feedback element, I'm going to misquote this, and I misquote it every single time, but I think I'll get it directionally accurate, which is your colleague Hunter Walk. I think he in this book that Scott Belsky wrote, Messy Middle and all that, he had this line in it where if you sometimes listen to your investors' advice, you might fail. If you always listen to your investors' advice, you're guaranteed to fail, or something along those lines. And I know he means that in the respect of VCs to founders, but do you find that thread to also pull the same way when it comes to like LPs to GPs?
Yes. I'll be the one that say yes.
Yeah, the answer is yes.
Yeah. And I think that actually circles back to what is that LP's goal for the investment? Because not all LPs have the same long-term vision and needs when it comes to investing in venture. Again, if you're a taxable LP and I don't want that money back for 15 years, keep it compounding. That's very different than that someone says, hi, in year 8, can you sell out via secondary because I need liquidity now?
Yeah.
That creates friction. That creates conflict where actually both of those LPs have different goals and different visions for their venture portfolio. So it's not necessarily anyone's fault, but sometimes that advice that's being given is driven by their own incentive alignments or their own needs versus what is best for the fund manager.
Classic example is I need to be able to take in X dollar check size from, one specific LP. So therefore that means my fund size is this. That can work. To be clear, that can work. But there are many cases where that actually kind of graduates you to a new portfolio construction strategy that may not be like your optimal superpower in terms of how you execute in venture.
Another one is, I've talked to a lot of LPs that don't like solo GPs. So I'm now like rushing and almost like forcing a equal partnership model with someone I haven't worked with before, or it doesn't totally make sense, or I've only known for 2 months. And that's like another one we hear where that just should, in our opinion, the GP should be doing what makes sense for them. Like if a solo GP at fund 1, 2, and then bringing someone on makes the most sense, great. If a solo GP forever makes the most sense, great. But it should be what makes the most sense for the GP.
You don't want a shotgun marriage.
Yeah. Don't get swayed by capital. You're better off closing a smaller fund and deploying a strategy where you have the most conviction and beliefs than doing something because an LP waved a lot of dollars in your face.
So much easier said than done, but like it is.
Agreed.
It is the reality. We see case after case, like in hindsight of that playing out.
Because is no guarantee that LP is back for your next fund.
Oh, dangerous. I love this transparency. This is why we do this episode. But speaking of transparency, I'd love to let our next caller in, Helen from Articulate.
Hi.
Helen, what's up?
Hey, Helen.
You got the podcast set up.
Hey.
Helen. Good to see you, Jamie, and nice to meet you, Layne and Lisa.
Have you guys seen Helen's new podcast? Like one of my new favorite ones that I've tuned into. So like, okay, before you even talk about your fun, Helen, can you talk about this new podcast in which you have?
Yeah, it's just like every other tech and venture podcast out there, but there are 5 female hosts. So imagine like a tech and venture podcast with female hosts. It's such a crazy concept. But yeah, it's been really fun because we've had a group chat going for like a couple of years. And one day we're like, let's just turn it into a podcast. And that's what we did. So yeah, you can just do things. It's been fun.
I really like the episode. Like my like gateway drug into that universe was like, I think you had an episode on options, like employee option pools and all that.
Yeah. Because like most of us have worked for startups before, and we've all kind of pivoted our careers. Like if you guys know Ashley Mayer from Coalition Operators, she's on the podcast as well. And like, we just talk about like, oh, well, when I got my box offer or my Dropbox offer, this is what the equity split was. And this is what I wish I had done, or I wish I had known. And I think that because we have the advantage of like not being like operators anymore, like we can kind of more openly talk about those things. Right. And so that was one that was really popular. And another one was like, we get a lot of questions. There's like at the end, there's a segment where like listeners can ask questions. And a lot of them are like, how do I become an investor? How do I break into venture? And so, we had an episode called Our SPVs for Chumps, because like Roelof Botha, I think, had a tweet about how SPVs were for chumps. And so we kind of had like a different take on, how do you build your track record if not with SPVs, or, if you don't have a bunch of money to angel invest. So yeah, it's been fun.
It's like this tongue-in-cheek podcast, but like we spoke about banter between like the Screendoor team and myself before we click record, and there is such playful and fun banter while actually learning tactical pieces of advice in your podcast. So I highly recommend checking it out.
So nice.
I think it's a woman thing.
Thank you. We're just funny.
It might be.
So
honestly, like I've listened to so many male podcasts, and it's just not fun to listen to. Yeah. I mean, I apologize on behalf of all my male colleagues, but I'm like, okay, they're insightful. Like I learned stuff, but sometimes you just want like you're cooking or you're like, exercising or something. You just want something playful in your ear, but it almost feels too guilty to listen to like only candy per se. And so what Helen has is like the healthy snack, like the granola bar or like the protein bar. And it's like, it tastes so good. Nice. At the same time, it's nutritious and you learn a lot.
That's so kind. Thank you. Yeah.
You heard it here first. Anyways, I can dally the point, but Helen, can you share a little bit more about yourself and about what you're building now?
Yeah, 100%. So I'm the founding GP of a pre-seed firm called Articulate. And the concept is really that I had a fund before. I've made a bunch of angel investments while I was an operator, while I wasn't an operator. And I just tried to figure out, after 55 investments, what's working well, but most importantly, where do I think I have an advantage and what do I love doing? And so I really wanted to get back to working directly, working side by side with founders, kind of the same way that I would as an operator. And so, my whole idea is that, I find founders before they're founders and I work with them really closely. Can I be a one person or a one woman YC or a South Park Commons where I help tell their story to the first people that they need to tell their story to, whether it's a co-founder, they have to convince to leave a big tech job to come join them on this mission, or a couple of really, early employees or key team members, whether it's like an investor or, maybe it's a design partner, the first person that's going to try the product. And so it's called Articulate. I think that's what I end up helping a lot of founders with. I think most of the companies that I joined as an employee, like Plaid or Facebook or Dropbox, I joined around Series B or C or D. And I think around those times, it's a much further along company. So I try to figure out, how do I apply that to something really early stage where as a CMO, I can't tell them about growth tactics or campaigns because oftentimes, they don't have a product yet, or they're just in the first phases of, kind of forming their team and their company. And so this is what I started, and it's been really fun. It's been 4 months so far. Yeah.
Awesome.
I love it. And I believe you brought a question for us here as well.
Yeah. So, when I talk to founders, one thing that I'm looking for is do they have a huge vision? Do they want to be the next Google, the next Facebook? And you want to make sure that the TAM is reasonably large enough and the size of their vision, makes sense for a venture, right? And I was sort of thinking what's the version of that for LPs? Because I think it makes sense that LPs want to hear an emerging GP say they want to be the next Sequoia Capital. But as an emerging fund manager, who's obsessed with her fund model, and I play around with that all the time, it's hard to, it's a different game as your fund scales. And so right now, with Articulate, I'm very open where I say it's not really something that I can imagine I want to do managing a fund that's larger than 50 million. And that disqualifies a lot of LPs. So I'm curious, for you, when you're looking at emerging fund managers, right, and you ask them about their roadmap, do you always want to hear we want to be the next Sequoia Capital? Do you always want to see the fund scale, or do you see it working or do you like funds that, might always stay sort of small? So curious about that.
I feel super strongly about this. So I will start. So this is obviously core to what we do at Screendoor. We look at funds that start at 10 million. And that's common for us. That's a normal day's work. So we actually love funds that are, staying small forever, so to speak. I think that the real answer is one, you can't be all things to all people. So said differently, you can't fit all funds characteristic desires of every LP. I think when you want to communicate ambition and, you use other, established firms and brand names to represent that, to me, the most appropriate correlation is around the level of excellence that you understand that running a firm with multiple funds underneath actually has. So it's about this high bar of excellence and knowing where that is. It's not necessarily around AUM and fund size. So for example, you can say that you'll stay quote unquote small, with air quotes, forever, whatever. And small, by the way, is going to be different. If you ask 10
right.
in the room, you're going to get 10 answers too. So for argument's sake, again, you can stay small forever, or you can have kind of a pattern and a path where you do want to build your fund size over time. And I think, I would isolate that into maybe a couple camps. So one, scaling is not synonymous with increasing fund size, to me, at least. Mm-hmm. To me, scaling means you're increasing in sophistication, you're increasing in focus, and that's really a sign of maturity. And fund size is a byproduct of that. So if someone's talents are, maximizing themselves at a strategy that means they are, for argument's sake, a $50 million fund forever, then they should be empowered to follow that path. And they're going to find LPs and partners that also lean into that thinking. Increasing their fund size to a point of playing a completely different game on the field than they've been practicing just won't work. It won't work for them. They'll be happy. It's like when you get promoted and then, you're just like, wait, I'm not doing the job that I used to love day to day. And then I think on the other side of that, like that said, you can definitely increase your fund size over time. And there's tactical and strategic ways to do that, where you can demonstrate how you've always been thinking and laying kind of like each breadcrumb for that. But there's a difference between scaling for the sake of scaling because you think it's what you're supposed to do next. It's kind of like what Layne was talking about in a kind of a prior iteration on this group today, where somebody adds a partner just because they think that's like the next logical thing that they're supposed to do, not because it's actually the best thing for them, their firm, their investments, their partnership. So it can go either way. But I think the challenge is when you end up having LPs that maybe have preferences for one or the other, it can kind of force someone who doesn't have that awareness of what's best for them into a path that they're not equipped to actually invest along.
Cool. So it sounds like it's not a disqualifier up front, at least for Screendoor.
For Screendoor, no.
Yeah. Cool.
I think too, one of the core questions we ask, but a lot of LPs ask, is what is a long-term vision for your firm and your brand? Because depending on what that answer is, actually informs me around how your investment strategy is going to play out over time. Where if the answer is I want to stay focused on pre-seed and seed forever, that does inform me that you'll likely be deploying all of your capital and you'll likely raise smaller funds. But if the vision is to build in reserves over time and to be able to start leading or co-leading or graduate from a pre-seed and seed fund to a seed and series A fund, that just gives me as the LP information around how the investment strategy will shift through maybe the first fund or into fund 2, because not every LP only underwrites for one fund. A lot of LPs, there's a lot of friction and complexity around changing out managers constantly. So ideally, you would want to find a fund manager, especially in emerging manager land, that you can back for multiple funds. And so you want to make sure there's alignment there. So if that means steady state's 200 million and I'm going to be a lead investor at seed, that's okay too. That may work for that LP, but being transparent with LPs around your long-term vision is really beneficial for finding sticky capital.
And I think maybe you love your fund model at this moment and you have this plan that at fund 4, it will look like this. Mm-hmm. And LPs are taught to hate strategy drift. And so your LPs will probably push back if you do change that plan over time. But I think we encourage GPs, as long as it's thoughtfully done and it's an evolution, your LPs just want you to make the best returns at the end of the day. So if the market changes or you realize your edge is actually playing at a different stage, or there's some way that you're going to generate better returns that is going to change your fund model from what you thought it was going to be exactly, that's okay. And it's actually better to be constantly thinking through how to evolve it and make it better, as opposed to just sticking with exactly what you said you were going to do at the beginning.
Just be transparent about it.
Awesome. Thank you.
One of the things that I chatted with the recent fund manager about, and they're thinking about, they used to stay pretty small and they started graduating to larger and larger funds, was the fact that they kept getting pulled. They were small check, or a 150K check into a lot of these rounds. So small check, but the founders of their portfolio companies kept asking them to be independent board members. And so they kept getting dragged into the board. And eventually they're like, I feel like I need to graduate my fund size because I'm doing what a lead investor would do. And the founders want me there. But I don't the founder has to fight back against their lead investor all the time just to get me in the room. And it might be easier if I just become the lead investor. And I think that sounds like that's an example of someone who's thought about it thoughtfully and not just graduated fund size, be like, I want to be a lead today, and all that kind of stuff.
Yeah, we always say crawl, walk, run. So if at fund 1 you are the third largest investor on the cap table, but by the time you raise fund 3, you've had the investing muscle and you've had the right to be the lead investor, and that's the best way, to Layne's point, to execute your strategy and produce the best returns, then you should likely raise a larger fund. And, that justifies the AUM increase. It doesn't mean that you're no longer doing pre-seed or seed. It just means your strategy has evolved over time, because you should always be a learn-it-all. And executing on excellence may mean I'm now 100 million steady state versus 50 million steady state. But either one is okay.
I love it. Well, Helen, thank you so much for coming on and asking that question to all of us. I'm excited for the next release of your podcast as well.
Thank you. It's called Great Chat. Forgot.
Yes.
Didn't mention that. Yeah.
I would highly recommend people check out Great Chat. And I don't know. I don't know if I should do this, to be completely honest, plugging other people's podcasts, but I love it so much. I just felt I've got to plug Great Chat, and people can find it on Spotify. I think it's on YouTube as well, Apple Podcasts, you name it, kind of thing.
Thank you.
All right. Well, thank you so much.
Your team.
Thanks for joining us.
Thanks, Helen.
Thanks, Helen.
Bye.
I'm curious for all of you, going back to what Helen mentioned earlier, proportionally, this is totally anecdotal, of funds that come to you and they pitch you, I want to be next Sequoia, I want to rise to be a $200 million fund, $300 million fund. Proportionally, is that the vast majority of folks you talk to? Or proportionally, do more people go hey, I want to stay lean, I want to stay small, I want to stay disciplined?
I think it depends on the quarter. There are some quarters where it's 100%, or I'm going to triple my fund size for my next funds, just as a heads up. And then the next quarter, we get kind of a large swath of folks that they no, this is my steady state. This is where I'm never going to raise $1 more. And I kind of don't really believe either of those, which is fine, because I just think that market conditions come up and everybody, should be adjusting their strategy. It's totally fine to put a flag in the sand right now and say, this is what I'm thinking and here's why. I think what a lot of folks miss is the why. So they may have a plan, they may have kind of a vision, but it's all about the why that supports that, backs that up, and not just the why from a market standpoint, but a why from that GP or team's standpoint. Because a lot of times, sometimes we see teams that, I think Helen was starting to point this out too, you see some teams that they do have the chops and the capacity and the market proof to scale their fund size. And then you also see some teams that they may want to do that, but they actually have a really strong advantage carved out in their small fund, lane, so to speak. Again, small funds in air quotes there. So I think it depends on the quarter. It depends on the week. Maybe it depends on the day. So.
Can I mention, Lisa, that you've been adding these air quote moments into it, and for the folks who are listening, this is a podcaster's dream where a guest also thinks in the form of a podcast as well, for those listening as opposed to those who are actually watching.
I might know a thing or two about this. Sorry, give me some credit. I got it.
Yeah, that's true.
It's not her first rodeo.
and frequent followers of the podcast can also we've had Lisa on a couple of times. So and I want to say, when you first did the air quotes thing in our very, very first episode, you were still acting out that. And for the listeners, they couldn't hear anything because we were actually using air quotes. Before I let the three of you go here, is there one last piece of advice that you would like to share to the folks listening to this, whether it's emerging managers in market right now or LPs thinking about investing in emerging managers?
My piece of advice would just be, make sure you think about how you as a person or as a team will be the most successful, drive the best returns, and then build your strategy around that. Build the sector focus around that, build the portfolio construction around that. But GP market fit is so crucial, and you want to make sure you're setting yourself up for the most success by being able to shine on what you're the best at and what your background and your experiences have set you up to do well.
I would say it's really, really important to ensure that you understand the population of what you're looking to invest in. That does not mean if there is 4,000 emerging managers, you have to meet with all 4,000, but it means that you need to meet and seek out a representative sample of the underlying population before you choose to make investment decisions. Because if you only make a handful of investments, you have a high probability of capturing the median return of venture, which is very unattractive. You're better off going and investing in the S&P 500 in an ETF in a liquid environment. And so I think it's really important to make sure you understand that subset of population, whether that means you're delaying investments by a year, or that means you leverage a fund of funds, or that means you leverage other investors in the ecosystem to help you do that market map. Because once you have an understanding of the population, you have a better shot of being able to pick top quartile managers. Because if you're not picking top quartile managers, you shouldn't be investing in venture. And it's really, really hard to do.
I think I'll give it two. I think one, for both GPs and LPs, change is okay. Back to our prior point, like, it's okay for a strategy to evolve. It's okay for there to be change. It's not, shouldn't be coded as like a default negative if there is a change. It's more about the context behind that change. And the second piece too is that, again, both for GPs and LPs, from a different frame of reference, like, speed to fundraise does not always equate to be a strong investor. It certainly can, but some of the best investors had, 18 plus month fundraises when they first started. Some, who have quick fundraises, maybe, the returns don't end up coming to fruition. So I think a lot of times there is an appropriate amount of correlation between fundraising length and speed, and that's all good. But a lot of times I think there is some over-indexing that can happen there, where sometimes the best opportunities are the ones that, take some time to come together and like continue to evolve. So I say that as advice both to GPs going through the process. If it was easy, everybody would do it. We saw what happened when everybody did it. So it's not an easy thing. What you're doing is really hard. So, don't let that get you down on the day in and day out. And on the LP side too, that I wouldn't over-index for, making an investment decision around somebody based on how their fundraise is going. Because we see some really talented GPs in the market where all it takes is that first yes. And then everything kind of catalyzes from there. So, and if you're really good at what the real job is, which is the returns, then we'll never have to have that conversation.
It's true. You need the lead domino.
There you go.
Well, thank you so much. And it's such a special thing because Lisa, I've had you on before. Jamie, I've had you on before. Layne, I will have you on, and that's a promise. And so it's so beautiful, just this, like, the first time, at least on the podcast, the Screendoor team comes together. And thank you so much for all your transparency.
Thanks for having us.
Thanks.
Yeah, thank you.
Yeah,
we love it.
This has been fun. We'll do it again.
Oh, we should do this more. Like, this is
our team meeting, right? And we'll just have our kids come next time, right?
And
I'll be the intern. Yeah. I'll be the fly on the wall. I'll be the intern. Amazing. Well, I'll see y'all soon.
Thanks, David.
Thanks, David.
Let me know down in the comments or on socials if we should do more of these. I hope you enjoyed today's episode with Lisa, Layne, and Jamie. I highly recommend checking out the earlier episodes with us. In fact, here are some of my favorite moments from the aforementioned.
I love this question because it's very specific to what your LP mandate is, but I'm going to answer this in a way that we look at it. So that venture capital bucket is the compounding machine for the family. We don't look to that bucket for liquidity. When you look at the long-term steady state return for, let's call it the 3 asset classes that I have experience with at Veritas. So worked on the public market side in the very beginning. That long-term steady state CAGR, so your compound annualized growth rate, is an 11%. Also worked on buyouts. That long-term steady state compound annual growth rate is a 14. And in early stage venture, that long-term CAGR is at 25%. So if you think about that in terms of a fund life, let's call it realistically 12 years for early stage venture. I mean, we could maybe go out to 15, 20. It's a pretty long-term marriage. But, when you think about the compounding benefits associated with early stage venture, if we go out to 12 years, if you're compounding at 25% for 12 years, that turns into a 14.9x. If you're compounding at 14% for 12 years, that's a 5. And public markets, which is 11%, gets you a 3.5x. So we don't look to early stage venture for early DPI. We have public markets, we have buyouts, and we have real estate, which provide different durations in regards to cash flow coming back. And it's important to have the proper mix of all those asset classes, because depending on what your ultimate investing mandate is for the family office, for the endowment, for the pension, whatever it is, you need to figure out that proper mix. Because for us, we're looking to get those long-term steady state returns. And that's why 90% of your overall return comes from asset allocation, not individual investments, because it's due to those mixes. So if I'm going to give the family that long-term CAGR of a 25%, that's going to be a significant contributor to their overall portfolio.
There can be, let's say we have 2 family offices. There can be one family office where you're managing what's called G1, Generation 1, Generation 2 capital. So that means that they're actively involved in the decision making for the investments that are in their portfolio. They may be sitting there, they may be on the committee, they may be actively meeting with managers. And then the second piece of that is the liquidity, where they have their spending lifestyles, their spending needs for their lifestyle. They have whatever their desires are for other asset classes, right? Because it's important to remember that venture is just one piece of many portfolios. They have, many folks are very philanthropic. And so they may have commitments that they've made there or desire to make. And all of those go into play with how much they can commit. And of course, when you think about the illiquidity and the locked up nature of the capital with venture, that's really important. The second example would be somebody where it's, call it G5 capital. So they are removed from any liquidity event. They are diversified out of, anything that came about from that wealth creation event. And they typically look more like what I would just say is an investment firm, right? They don't look like a traditional family office. The family may or may not be involved in the decision making. You may not even know who the family is, because again, these are all individuals where if you're working at a family office, like I always viewed, it's very important to maintain the privacy and confidentiality of those people, right? They have their own lives, they have their own ambitions, and that's part of our role in those situations. So with those family offices, they may have a more robust portfolio. They may be able to do more dynamic things depending on how much time they've had to evolve that portfolio over time. And they will probably still have the same, call it liquidity needs, but they might look a little bit different. They may be focused more on generational wealth transferring, on, of course, the charitable component. And many, again, are still very philanthropic, and that's an important part of their legacy. But those are 2 very different family office profiles where venture can absolutely play a role, but it may play a role in how much they commit, how often they commit, how they work with managers. One may, again, they just are not necessarily in and out of the asset class very deeply. So being embedded with a manager versus somebody working at a traditional investment firm, they, have a different perspective on what they're looking for with a manager.
Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are 2 small things. 1, there's a little red subscribe button down there if you're on YouTube, and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click. You'll get many more presents, many more insights, and many more brilliant minds straight through the internet vines just like this one very, very soon. 2, it'd mean a lot to me if you could share it with one other friend who could gain a lot from listening to today's Cosmos of Insights. Also, let me know if there's anything I should have asked down in the comments, and if there's enough interest, we'll have today's guest back for an even spicier part dose. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more helpful and fun for you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I wanted to share a quick disclaimer. The views expressed in this podcast are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we're a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. I'll see you on the next.